Good afternoon, and welcome to the Banking Customer Experience Dividend 2016 webinar. My name is Mark Guinibert. I'm a partner in our KPMG customer business here, and I'm joined by one of my colleagues, Dave Conway. Do you want to give yourself
an
introduction?
So I'm part of KPMG Nunwood, and one of the authors behind the white paper that we issued about 2 weeks ago. That's going to be summarised in this webinar this morning.
That's right, and there's been an awful lot of interest in that white paper, particularly around people looking at how they can deliver superior customer experience and get that superior rates of growth that you talked about in the white paper, Dave. So, hence this webinar, and it'd be great to get any feedback from you as we go. The banks are very well represented in the top 100, the Nunwood top 100, but the big four banks in the UK, with the exception of Halifax, are sadly absent from that top 100. So it'd be interesting to try and understand why the smaller banks and new entrants are doing so much better. There could be many reasons for this, and we're going to have a look at some of those as we go through today. Be again interesting to get your views on that. But one hypothesis is that the bigger banks, have really been focused on not doing anything wrong, rather than focusing on getting things right for the customer. That's just one of many possible hypotheses. So we'll examine that and a lot more as we go forward. So just taking you through. We're going to talk about why it's worth investing in the customer experience dividend. We are very convinced that the rates of growth make it attractive. We're looking at the current state of the banking sector, and then having a look at some of what the very best exponents in this market deliver, looking at best practice, and then a quick look at the future and how we get there. Just before we kick off, want to pose a question to you all, and you'll see something popping up on your screen in a moment or two. So it'd be great for you to insert your thoughts and your comments to this question. So what is the biggest single barrier to customer experience in your organisation? If you could give us your thoughts on that, and then we'll try and summarise some of those when we get towards the end of the webinar. But without any further ado, Dave, over to you. Do you want to take us through?
Sure. So, well, good afternoon, everybody. And I'm going to start with just a little overview for those of you who've not encountered the Customer Experience Excellence Centre before, and just give you a little bit of background as to what it is and what it does, and the work that we've done in the area of banking. That would be particularly insightful and relevant, hopefully, for your organisation. So, the Customer Experience Excellence Centre is now 6 years old. It was designed to answer 4 questions, the first of which was, what does a great experience look like from the customer's point of view? The second, well, who in the world delivers that great experience? The third being, what is it that they do? How do they go about delivering a consistently great experience? And then the fourth question was, well, how do we codify that into a set of norms, into a set of procedures that organisations can adopt to improve their own customer experience? And right now, 6 years on, we have 1.25 million customer evaluations of some 927 brands in the UK, the US, Australia, and more recently, the Republic of Ireland. So it is a vast repository of information. It is available and accessible without charge from the KPMG Nunwood website. And we will be publishing our next analysis of the US market, in fact, in probably a month or so's time. And so something to look out for. So that's the Excellence Centre. And the last of those questions that I talked about was, how do we codify customer experience excellence? And those of you who are aware of the Nunwood 6 pillars, I hope you forgive me for a second or two if I just sort of run through them quickly for those who aren't. So the first is personalisation, so the degree to which the experience is tailored, or feels tailored, in fact, to the experience or the circumstances of the individual. And what we've seen over time is that increasingly in the area of personalisation, what makes the difference is actually how the individual is left feeling about themselves. This is particularly true of the banking market, in the sense of customers want to feel valued, They want to feel that they're important to the organisation. But fundamentally, they want to ensure that their long tenure with a bank is recognised and more these days rewarded. The next on our list is expectations. Expectations, I guess, arises in two areas. The first is the brand promise. So what is it the organisation is committing to do? But secondly, what does it do on a day-to-day basis in terms of setting, managing, and on occasion exceeding expectations? And time and effort. So we're all time poor, aren't we? And there's a lot of discussion that says that actually time is the new wealth. If you have time, then you are particularly well off. Organisations that recognise that it's a limited resource, and organisations that focus on enabling their customers to minimise the time involved in achieving an objective and reducing the amount of effort, whether that's sort of thinking effort or cognitive effort, whether that's physical effort or emotional effort, whichever of those it is, if the organisation signals that it's working hard to make life easier for the customer, we see a direct link between time and effort and loyalty. And outside of the banking sector, Amazon being a very good example of an organisation that's managed to perfect that with one-click ordering. Integrity, particularly important within the banking sector, and we see three levels of that. The first is, what does the organisation stand for? So what is the purpose of the organisation beyond just making money for shareholders? And increasingly we're seeing a move amongst consumers to move to organisations that are increasingly authentic, where there's great congruence between sort of word and deed. So what the organisation says about itself and then how it delivers that. The second area of integrity is competence and the ability of the individual that you speak to deal with your issues or questions at first time of asking. And then finally, the way in which the organisation meets its promises or doesn't meet its promises. So those are the three tiers of trust and integrity. Resolution, so the ability of the organisation to fix things when they go wrong and to do so in a way that leaves the customer feeling much better. Some recent work that we've done with a major bank looked at something that's called the service recovery paradox, which is where we see that if an organisation makes a mistake and fixes it well, then actually the NPS score of the customer increases. And so the sort of analysis that we've done shows that if the mistake is not fixed particularly well, we see a decrease of 10 points on the NPS. If it compounds and other issues arise, then it drops by 45 points. But actually, if it's put right, then we see an increase of 10 points. So in the banking world, fixing things well is really important. And then finally, empathy, the ability of the organisation to connect emotionally with the customer, to put itself in the customer's shoes, and for the individual that you're speaking to be able to reflect back to you the right emotional response to the situation that you find yourself in. So those are the 6 pillars, and we research those every year, and each year we validate that those are the 6 that are the most significant impact on customer value for an organisation. So what I'm going to do now is take you through some of the latest thinking and some of the latest analysis that we've done, looking at the contribution that experience makes to the commercial outcomes of the organisation. And again, some of you may have seen this sort of chart before. This looks at the contribution that the 6 pillars makes to 2 of the sort of key metrics that we see within financial services. The first being advocacy, the second being loyalty. And we know that the explanatory power of those 6 pillars is around about 65 to 70% of those 2 scores. And you can see that personalisation there makes the strongest contribution of all of those. And we'll see a little bit later that personalisation really is where the future of banking customer experience lies. So if we look at how that plays out within an organisation, so why would an organisation seek to invest in its customer experience? What we see is a sort of a value chain, really. It's a sort of continuum between the customer experience that's delivered and the creation, ultimately, of shareholder value by the organisation. And we've worked alongside some pioneering work by the American Customer Satisfaction Institute and the University of Washington here that looked at the relationship between customer satisfaction, NPS and loyalty, and how that then played through to shareholder value. And it's tiered really in sort of 3 tiers. The first of those is the 6 pillars, which we've just taken a look at. But the first order impacts of those, the first order results of those, are the sort of the higher level metrics that organizations tend to use. In particular, financial services, an organization or an industry that's moved from customer acquisition to customer retention. Cross sales, the whole essence of bank assurance is about the ability to sell other products to an individual customer. Price sensitivity. So we live in a very price-sensitive market. In fact, it's described as the switching economy, and it's easier than ever for customers to move around based on price. So what contribution does experience make to preserving a customer's loyalty with an organisation? And then finally, positive word of mouth. So I think most of the banks now are focused on NPS and advocacy, and we know that the 6 pillars drive each of those 4 dimensions. The second order results are those that divide equally between cost reduction and revenue improvement. So above the line, we see that it reduces costs in terms of acquisition, in terms of cost to serve, and maintaining the stability of the customer base, so not having to deal with the additional costs of churn and acquisition. But also, should the organisation choose to, it gives the opportunity around increasing prices, increasing sales, and getting the benefits associated with a sort of more positive PR and more positive reputation. Now, ultimately, these flow through into the 4 key drivers of shareholder value, and the conventional methodology for doing this is using cash flow analysis. And the cash flow analysis that we've looked at here that's particularly relevant to the customer experience is firstly sort of pulling cash flows forward, so the acceleration of cash flows, so incenting customers to want to do more with you sooner. Lower volatility, so cash flows can be significantly volatile over the longer term. A more sustainable and stable customer base means much less volatility in cash flows, which makes the organisation's reserves management much easier to do. Increased cash flows, and then finally, the higher residual value. The value of the organisation is augmented by the investment that it makes within customer experience, and that value then manifests itself in shareholder value. So we see that continuum, and there's a number of studies, and we're about to issue a paper which provides further detail on how this plays out within the financial services sector. But it is the sort of governing mental model really that we use when we're looking at the economics of customer experience excellence. Now, recently, we were keen to understand the relationship between organisations that focus on customer experience and organisations that perhaps are less focused on customer experience. So we did a straight side-by-side comparison of the top 100 organisations in the KPMG Nunwood Customer Experience Excellence Index and companies that are in the FTSE 100. Now, we normalised the samples on both sides to ensure that they were comparable. But in essence, what we saw is that organisations that focus on the customer experience grow twice as fast as those organisations that don't. And the second part of the analysis showed that actually if we look at the profitability of the businesses, so in terms of EBITDA, what we see is that whilst both populations have suffered margin erosion over the last 5 years, organisations that focus on the customer have been better able to manage the preservation of their margin than those organisations that don't. And by a significant factor, by a threefold factor. So we know that a top 100 ranking drives commercial outcomes. We know that it provides improved commercial returns for shareholders. And if we look at financial services, we can see that broadly, if we draw a comparison between the financial services businesses and the FTSE 100, we see that the FTSE 100 grew at about 5%, whereas financial services on a similar basis by 14%. So significant benefit associated with investing in the customer experience within the FS world. But let's put some numbers around this now. So what we've done here is we've looked at the combined revenues as forecasted by market analysts, in this particular case Thomson's. And the bottom blue line is the line of forecast from the market analysts. What we've then done is apply the superior returns associated with a better than market average customer experience. And that's the shaded line and the red line which you can see sort of expanded out in the bubble there on the screen. Now, what that says is there is something like a £9 billion revenue advantage that is available to the major financial institutions were they able to harness the quality of customer experience, and if they got the same benefits as organisations that do. So a number of ifs in there, and this is the sort of analysis that is directional rather than empirical, but it does say that there is some embedded value associated with the value of customer experience that is realisable if organisations choose to focus on it. So I'll just wait for this slide to build for a second. So the second part of the analysis that we've conducted recently is to look at price sensitivity. So we conducted conjoint analysis across 7 different industry sectors. And we looked at the dynamics between 2 components. So the dynamics between price and loyalty, and the dynamics of customer experience and the improvement within that customer experience, and try to understand the relationship between the two. So the blue line on your screen now is the demand curve for a conventional package current account, which has a base price of £10. So in this sort of analysis, we need to make sure that all things are seen to be equal. Now, this particular bank, if it increases its price, you can see the demand curve shape based on £1 increments. But perhaps the most startling thing in this particular bank's case is that actually, for those people currently paying £10 for their current account, actually only 75% of them actually believe that that's good value at this particular point in time. And if the price goes up £1, you can see that actually some 40% of people will be retained, but actually 60% of the customer base will erode. So what is the opportunity associated with improving the quality of the customer experience? So if we look at incremental improvements in the customer experience on a kind of 1% basis, you can see that we start to build another line. And this second line here, the red dotted line on your screen, is the retention curve based on an improvement in customer experience. And so you can see that the line starts to become less elastic, it's more inelastic, which means that the better your experience, the more likely you are to retain existing customers. And you can see that the line becomes more and more inelastic as the experience improves. So again, another indicator really of the value associated with improving the quality of customer experience and the impact that it has around price sensitivity. Now, many organisations, of course, wouldn't choose to use that price or to price upwards in the market. But what it does show is that that embedded financial value is the value that actually keeps customers in the organisation in the event of competitor moves in the marketplace. So always up, it's a strong indicator really of the benefit associated with investing in the customer experience. So let me move on now to sort of a quick look at the sector. So I don't know, Mark, whether this would be a good opportunity for you to start to think about and share your thoughts really with our listeners in terms of where the market is and slightly where it's moving to.
Absolutely, yeah, thank you for that. And if you look at slide 15, there's a very interesting graph that ranks all the industry sectors that the Nunwood Excellence Centre has researched into. So you see at the top of the stack, grocery retail being the highest graded customer experience across all the sectors, going all the way down through other financial services, utilities, into public sector being towards the back end. I guess what I find quite interesting is that the top layers actually have been pretty static. So the next layer up is the delta to how they ranked in 2014. So if you look at grocery retail, they kept their place as number one, but actually the quality of their customer experience has dropped by 1%. Banks just haven't changed over that 12-month period, and that's really quite telling. Customer experiences have increased. We all know that our customers expect more. They expect more for less, and that's a situation that's not going to go away. But the banks haven't really made overall any progress. Now, clearly there have been some movers and shakers, and we'll have a look at that in a few moments. But as an industry, the banks have not moved forward. Conversely, you've got some really big movers. Utilities at the bottom end, although they have started up with a pretty low base, they've actually made a big step forward in that last 12 months, jumping by 7 points. So, all credit to those guys. But I think the banks really need to do more, particularly if they want to cash in on this dividend. So, turning over onto the next slide, which is what we call the S-curve, and you can see why we call it an S-curve, because there's a full S. We're concentrating on the top 100 here, so we're not sort of naming those that are perhaps lower down in the stack. But as I mentioned in the introduction here, with the exception of Halifax, the big four retail banks in the UK are not represented in the top 100. And what that really means is that of all the current account holders in the UK, about 75% of those current account holders are being served by people that are not in the top 100. That's kind of good and bad, really. It's good in the sense that there's a great opportunity to make a big difference here. Bad in the sense that 3/4 of the population are not really being served by people that are better than the midpoint. What's interesting though is you've got some really big climbers. People like Santander have really climbed up the index. They've really focused on building out how they serve their customers. And you have to look at them and admire what they've done, because they've really made a big step forward. This is not, they're not moved up 1 or 2 points here. They've really made a big step forward. The other thing is that it's dominated by mutuals and smaller banks in that top 100 space. So what is it that those smaller organisations, or perhaps more focused people like Santander and Halifax, have been able to do that have escaped the people that are in everything below the top 100? And now I think that really comes back to a whole series of hypotheses, and I mentioned earlier on that maybe it's something to do with the fact that the bigger banks have been focused on not doing anything wrong rather than getting things right, whereas the smaller banks have been really focused on the customer experience. There's a whole load of reasons kicking around in the market, but it may well be that they've not been able to get the insight to point themselves in exactly the right direction, or maybe it's a transformational capability that they're not being able to transform themselves as quickly as these smaller banks. But whatever it is, there's some people that are doing a lot of things right, and if you look at that cluster of banks in that top 100, actually that's pretty good, isn't it? For an industry sector, banking, that hasn't perhaps had the best reputation over the last few years, there is a good clutch of people that are doing a great job, actually, doing a really good job across all the sectors in the UK. So, examining why perhaps some people have done less well, and it comes back to what Dave was talking on earlier on, I think, about the 6 pillars, and he quickly took us through the 6 pillars: the personalisation, meeting the expectations of customers, time and effort, and then exhibiting integrity, and delivering that service recovery paradox, which I think is really important. But the final one is that empathy. It's about understanding your customers and being able to relate to your customers in normal day-to-day interactions. And that empathy needs to happen in face-to-face or telephony-based interactions, but also it needs to happen digitally. We all know that many of these interactions that we have between bank and consumer are happening on a digital technology basis, mobile basis. So you need to think about how you connect with your customers on an emotional level, understand your customers, respond to your customers at that emotional level digitally. And there are many organisations that do this really, really well. So we're not talking about the art of the impossible. We're actually talking about the art of very much the possible. So I think there's a lot to play for here, and I think that the banks, particularly in the digital space, have a lot of progress to be made here. So again, a story of great opportunity as opposed to a systemic problem that's not fixable.
Thanks, Mark. It's interesting looking at those slides. That if we look at that S-curve, the vast majority of the organisations on there are either mutuals or former mutuals. And Santander is a combination of 3 former mutuals. Halifax, a former mutual. Coventry Bank, a former mutual. I wonder whether there's something in the nature of the relationship that mutuals have with their customers that maybe puts them in a slightly different place to where the banks are. Would you think that's a reasonable observation, Mark?
I think so. Certainly when you visit some of these organisations you just mentioned, there's a different feel to the way the organisations look after their staff in some cases. So maybe what we're witnessing here is a situation where there is a different culture, there's a different way of looking after staff that means that those staff look after their customers in a different way. And that's probably worthy of some further research and some further thought. I mean, intuitively it does make sense, doesn't it? But it's definitely worth some more theoretically based research.
Good. Okay. Well, let's move on then into slightly different territory, which is to look at where the market opportunity lies going forward. And one of the areas that the report touches on is the millennials. Intriguingly, something like 30% of banking transactions will be undertaken by millennials by the year 2020. Now, if you think about the fact that we also have an aging population, and another report indicates that something like 35% of transactions will be undertaken by people over the age of 50 in 2020, then actually 2/3 of the banking activity will be undertaken by 2 fundamentally different populations of folk, which has, some impact in terms of the way that people think about segmentation, how they think about product design. But the area that the report focuses on is around this concept of the millennial time bomb, because this age group, the 18 to 34-year-olds, see the world in very different ways. They must become significantly important to banks as time goes on. But the central issue is that this particular group, lived through 2008 and have a somewhat jaundiced view of the banking framework, both in this country and other countries around the world. And actually, this is the group that are thinking about organisations like Apple and PayPal and Google and Fintechs as being the solutions to their problem. And they don't see the bank assurance model as being relevant to them. They actually see that they pick best of breed based on what they want to do and what they want to achieve at that time. It's just another app that sits on their phone that they access. So an area that banks need to think about and start to address, I think, in a probably more proactive way than I guess we're currently seeing. So let's take a quick look at some of the leaders around the world are doing, and look at some case studies. So as Mark talks about, personalization and anticipating what the customer needs are probably the 2 guiding lights that we see at the moment. Almost hyper-personalization taking place. But the context of anticipatory services is different. This is about being able to provide things to your customers before the customer realizes they need them. So we're seeing banks talking about next best action, and often in the context of product, but actually next best action in the context of service is also where we're seeing the leading organisations starting to focus. And one of the organisations that has topped our US poll last year, and we'll see how well they do in the poll that's coming out in the next month or so for the US, is USAA, and long been an organisation that we've tracked. and an organisation that's built their entire approach around empathy. Empathy in the sense of deeply understanding their customers at such a profound level that all of their innovation program is focused on solving specific customer problems. It's less about finding homes for new technologies and much more about how can we make life easier for our customers. And in these previous webinars, we've touched on some of the apps that they developed, but they were the first organisation to allow smartphones to photograph checks and deposit checks, largely because that was particularly appropriate to their customer base. They're also an organisation that's focused on how do we use our data, less about selling more to customers, although that's something that we're concerned about, and more about how do we equip our customers to be more effective in their lives. And one of the apps that we've seen where they've taken this to its logical extension is their car buying app. So USAA have focused their organisation around the light event of buying a car and developed an app that solves many of the problems associated with doing that. So they use their transaction data to look at the sort of discounts that a particular dealership provides, so equipping their customers with the right level of negotiation knowledge and skill. They've looked at the sort of insurance needs that their particular customer base has, and then they've wrapped that together in a very simple app that makes the whole funding, acquisition, insuring, incredibly straightforward for all their customers. And why? Well, their customers, members of the US military, spend very little time in the US and are constantly moving. So anything like purchasing a vehicle or dealing with the aftermath of an accident is something that USAA have focused on removing all the issues that bureaucracy is out of. And the second one that we noticed when we were looking at USAA was their insurance app, where when you have an accident, you photograph the scene, you dictate into the phone what's happened, your phone is paged for the GPRS coordinates, the weather locally, you press a button and off your application goes or your claim goes, and they guarantee to get a replacement car to you within 1 hour. Now that solves customer problems. And it's an emotional situation when you have an accident. So when Mark talked earlier about carrying emotion through digital means, this is where the application of digital solutions to emotional problems starts to build an emotional connection with the organisation. And in a world where we're going to see 90% of banking transactions conducted digitally in the not too distant future, with only limited amounts of human-to-human connection, this is where we think banks are going to have to start to look to improve that connection with their customers. Another organisation that is focused on a life event is Kiwi Bank, on the buying a property or buying a house. And we've seen, Zoopla and others in the UK putting together information on historic sale prices on properties. But this app from Kiwi Bank takes it one step further and allows you to scan a street to see which house, using augmented reality is for sale, what the state of that property is, whether it's been rented, and then it allows you to do some what-if analysis. So what if we upgraded the kitchen or converted the loft or, changed the bathrooms? What would that do to the value of that particular property in this particular neighbourhood? So, very clever technology is being used to go one step beyond just equipping the customer with information, but actually allowing the customer to simulate and predict outcomes of particular events or to do things, in remarkably short order. So two organisations really that are, pioneering the way forward. Santander is an organisation, again Mark touched on this, that have transformed their business. 5 years ago they were being vilified as the worst bank in England, and they had a big task, integrating Alliance on Leicester, Bradford and Bingley and Abbey. Moved them onto a single platform, have rigorously focused on driving down the amount of rules and issues and procedures that get in the way. The 123 as a hero account has been uniquely successful as part of their customer acquisition strategy, but they focused also on the welcome process, so ensuring that the first thing that happens to new customers leaves them a really positive impression of the business. Their use of brand ambassadors, so Jensen Button and Jessica Ennis-Hill, has been hugely successful in terms of the psychology of what they've been doing as an organisation, and the consequence is that they've moved well over almost 100 places in the last couple of years and have done so hugely successfully. Final part of the mix, of course, was empathy training. So training all of their people on how to engage and create an emotional connection with the customer. The future now is, how do we get there? So how do we sort of move forward? And for us, I guess, as sort of observers of the banking industry, the mindset that we've seen historically has very much been one of, how do we use our data? How do we encourage our customers to buy more from us? But that's been through a sell more paradigm. It's been, reducing costs of customer acquisition, reducing costs of direct mail, but at the same time driving business activity. And that's a kind of, a different model. That's a sort of push-through model. The model that we're seeing emerging in the US is more of a pull-through model, which is, how do we equip our customers to do more? How do we enable our customers? With this massive data that we collect, we should be able to equip our customers to make informed decisions at the point in time they want to make that decision. And if I'm driving down the road and need to fill my car with petrol, which petrol station's got the cheapest price? Well, there's no reason why my bank can't tell me. After all, it's processing huge quantities of transactions from that establishment. Or if I want to buy a particular product, well, again, there's no reason why my bank can't tell me who is selling that product cheaply and where would be the best place to go for it. So being able to equip customers, being able to enable customers, being able to put customers in a powerful position in emotionally rich situations is where we see the sort of the movement going to. It's less about looking at Fintech and saying, well, what can we replicate, what can we copy? Much more about saying, what problems do our customers encounter, and what can we do to leverage our asset base to make that customer more successful in dealing with that problem. So, Mark, I think we probably can move on now to how organisations might think about moving forward. And what are the sorts of things that those businesses need to think about, really, as they move into transforming what they do around the customer?
Indeed, yeah. So execution, the ability to execute and transform, is a real source of competitive advantage. So if you think about the components of transformation, those organisations that have that vision and know where they want to get to, and have all the components of transformation lined up so they can deliver a better quality customer experience, perhaps along the lines of what you were just talking about with the USAA example, empowering their customers, creating digital-driven empathy, helping people with their financial lives. Being able to deliver against that rather than just talk about it is really where those organisations are building success. And we're seeing some really good examples of organisations that have invested heavily in building the infrastructure and decision-making components and governance that allow them to decide where they're going to invest, and then building those components that allow them to transform those organisations. So those organisations really do deliver that superior customer experience, and typically deliver it in a way that is much more economically satisfactory for the shareholders as well. There's a lot of thinking that's going into this area about actually poor service costs a lot of money. Good service can save a huge amount of money as well. So these two things putting together, building faster rates of growth off the back of a superior customer experience and reducing the cost of the operation by taking out the cost of poor service and putting in a lower cost of good service have really benefited some of the banks, particularly those that are in the top 100 and making big steps. Key things being, you need to know where you're going, hence the vision and strategy, and getting that voice of the customer. Voice of the customer is forever changing. The customer's expectations are forever increasing, and the customer wants more for less and more quickly and with more empathy and the like. But if you're not picking that up and understanding where your customers have concerns or where they value what you're doing, in quasi-real time, it's very hard to point your transformation artillery weapons in exactly the right direction. So that understanding and that ability to focus, that ability to make decisions that will allow you to invest your limited investment pounds to those areas that have the best impact for the customer and best impact for your organisation and shareholders are those people that are winning in the market. And going on, and in terms of what are those components of transformation, then you need to think about digging into that, which is the customer insight framework, that ability to identify those specific areas where the enterprise need to focus their time and effort. And this is about those moments of truth that are more important than others. It's those moments of truth where perhaps you're not as good as your competitors, as opposed to just trying to improve everything. It's about really focusing in the right areas. Having that capability to design your own journeys and design your own journey architecture and wrapping that with a governance structure, again, is really important. So we see a lot of people, unfortunately, mapping journeys, mapping idealized journeys, creating wonderful pieces of wallpaper, but the organization lacks the governance to then say, right, the insight we're gaining from this and our customer feedback is we need to invest in this particular area, and then driving execution in those areas is comparatively rare. And that comes back to what I mentioned a few moments ago. It's about that financial decision making in the right areas. We touched on the people and behaviours piece when we were discussing organisations that have that mutual heritage. That customer-focused empathy, doing whatever it takes to do the right thing for the customer rather than the pursuit of a sales target. That's another thing that, again, we're seeing being a real winner in the market. And clearly your ability to change your technology, your systems. There is no bank out there that says, oh, it's trivial to change our core banking engine. So those that have a slight advantage in that area or have the ability to marshal their resources in a way that's effective so that they can implement change, test and deploy in rapid pulses of activity, those people have a real head start in this space. And that wraps into the final sort of transformational capability. The ability to run the bank and change the bank all at the same time is not a trivial problem, but those people that do it well really are doing better in the market, quite clearly. And they can respond to that customer feedback that says that this is the area where we see your bank underperforming in the market, causing agitation or giving a lower quality of service. So all of those things wrapped together really do make a huge difference. So I think that brings us towards the end, Dave. Do you want to wrap up for us?
Yes, I think we've been on a little bit of a journey, haven't we, through the economics of excellence and how that plays out within a large organisation. A couple of things that I'd just pick out. First of all is that I know that some of you may have had one or two technical issues today. If you have, then a version of the webinar will be put up on YouTube on the Nunwood TV site. So please go and access that. So I think it's only a very small number, so hopefully everybody else has been okay. And if there is further information that you want on this subject, the banking report is available from Nunwood and is available from the Excellence Centre. And there's a range of other deliverables and collateral material that's there to support. So I think from our perspective, it's now it's an opportunity to look at the poll results. I don't know if those are all in now, Mark, or
we've got some good responses actually. Yeah, so let me just quickly take you through those. So the biggest reason why it's tough to change your organisation has come out as an organisation stroke cultural issue. That's the number one barrier a little bit more than a third of all of you on the webinar have said that is the most difficult thing to overcome in terms of your organisation, and that's interesting, isn't it? Because that plays back to some of the discussion we had about the customer focus, and absolutely doing the right thing for a customer when you have a mutual heritage, where of course you are owned by your customers, you're owned by your members, so actually meeting your shareholders' expectations is the thing that you have common with the bigger enterprises, but it just so happens that your shareholders happen to be your customers at the same time for those from a mutual background. The second biggest thing with almost a quarter was that many of the propositions appear or feel as though they've been developed from a inside-out perspective. So they've been developed by the business for the customer rather than developed with the customer's perspective and the segment or the needs of a customer segment in mind. And that, again, really does focus back in on the case study that Dave took us through on USAA, where everything is geared around what is happening in a customer's life, what's happening in their particular journey, and you design the products and services around that rather than, right, why don't we try and flog them some insurance? Why don't we try and flog them a car loan? Well, actually, it's all about buying a car. It's all about dealing with an accident, etc. So those really do correlate with what we see. So that's been very interesting, and thank you very much to all of you that have voted in that space. That's much appreciated, and I think reinforces many of the things that we feel at an intuitive level, but it's good to get some statistical backup from those of you in the industry.
So one of the things that we're currently looking at, so it's interesting that 35% of the respondents talked about culture as being at the heart of moving customer experience forward within the financial sector. One of the things that we're looking at the moment is what we've called the human value chain, which builds on some work that you may have heard of in the past called the service profit chain. And the human value chain looks at aligning what we do internally in the organisation around culture and values in a way that allows the 6 pillars to emerge naturally in a way that we then engage with the customer. So it starts with culture, it looks at the employee experience, it looks at employee behaviour and leadership behaviour, it then looks at customer experience, customer behaviour, and then financial outcomes. And it's that alignment across that chain that makes organisations like Kiwibank and USAA so successful. So let me just check, have we got any questions that have come in, Mark?
We've got some really good and interesting ones here, actually. So I say that as though that's a surprise, no, actually. Some really good questions, as per normal. There's a really good question about digital and personalisation. So I'll read it out. With millennials, how do you personalise the relationship with them when everything of theirs is done over technology, which by its very nature tends to come across as impersonal? So we have sort of touched upon this, Dave, but do you want to sort of give a view on personalisation and creation of empathy through digital and electronic channels?
Sure. So I suppose there's 2 parts to this, but we do know that millennials, once they want to have their lives mediated through technology, they want a human being nearby at points in time where they need human contact. So making that human being readily available, Kindle in terms of their rescue button, is a really good example of an organisation that's managed to make that human contact almost instantly available. But the second part of this is, again, going back to solving millennial problems. And one of my kind of favourite apps at the moment is by a company called Digit in the US. And what Digit do is they scan your bank account. You give them permission to look at your transactions and your cash flows. And at various points in time, they actually take money out of your account and put it in a savings account when they think you can afford it. Now, in the US, student debt is a bigger issue than it is here. They have higher rates of interest to pay. So getting down your student debt sooner rather than later is a key driver for millennials. So apps that allow them to do that and do so in a way which are, almost invisible, are highly successful, and the adoption rates of Digit have been extensive. And that's a good example of an app that actually millennials feel emotional about, because it's solving a life problem for them, and it's doing so in a creative way. Now, I guess in the UK, we're probably saying, well, we've had sweeping into accounts at the end of the month for, many years, and some of the banks have the ability to, move money into a savings account, when it's appropriate. But the reality of it is that, that particular app has hit the time and effort button brilliantly. You don't have to think about it. It just does it. And if you need the money urgently, well, you can just, within 24 hours, it's transferred back into your account. So I think for the millennials, it's the ability to access human contact quickly and when needed. And it's the use of technologies that play to human needs in a way that solve their problems.
I think that's right. I think part of the problem that people have with technology is they think empathy means hearing words like, oh, I'm so sorry you're in that situation, I really want to help, which of course can't be delivered on an iPhone. But actually, it's about helping people resolve stressful situations in their life or in their financial circumstances. So you don't have to have that sympathetic ear of somebody that's giving you good body language and good eye contact if what you're doing is providing an app or solution that really solves that person's financial or lifetime problems. So the insurance problem, or buying a car problem, or buying a house problem, anything that helps in that space actually delivers a really good quality empathetic experience. So don't mistake sympathy for delivering a good quality business solution for your customers. So if you focus on delivering a good quality business solution for your customers, there are loads and loads and loads of different things that can be delivered. There's another question which is off the back of this, which is if we're going to fix all the digital stuff for the millennials, how do we make people more empathetic in a face-to-face interaction? And I think you touched on this, Dave, with Santander about people changing the way they deal with customers in branches. Do you want to talk about that a bit more and that actual face-to-face delivery of empathy?
Sure. So I think probably what's interesting is that if we accept that 80–90% of transactions are going to be conducted digitally, it means that whenever the human interaction takes place, it's got to count and it's got to be memorable. Now, one of the sort of things that our research shows within banking is that a number of banking staff often confuse aloofness with professionalism. And historically what we've seen is that almost there's a divide between the member of staff of the bank and the customer, that member of the staff doesn't feel comfortable in stepping beyond. And that can be perceived as coldness or aloofness or worse indeed. And that's what we see frequently in all these sort of the surveys that we conduct. But individuals that are able to make that one step, that emotional connection, who are able to build rapport, who are able to, connect at a human level, in a very human-to-human way, are hugely successful, in fact, disproportionately so. Now, the perplexing issue here is that as human beings, we are hardwired to be empathetic. We have a thing called mirror neurons, which allow us to understand and, pretty much intuit exactly how somebody else is feeling. And yet there's something about large organizations that makes us switch those off and not act upon them. And, if I look at the work that Santander did, which was very successful, it was as much about granting permission to be friendly as it was about teaching people how to have a conversation with a customer. I mean, we have conversations all day, every day. What is it about a customer where we suddenly have to talk in a different way? And I think that's years of accumulated training, sales focus, the needs of the bank coming before the needs of the customer. But when you turn that round, actually what customers want is a friendly conversation. And, we see millions, literally, of verbatim comments on a monthly basis saying, praising people that are able to be friendly and helpful and human, and actually not so happy with those people that are cold and aloof and a little distant.
And it also plays into the trust arena as well. So those people that are able to be human, move away from that aloofness, perhaps hidden under the cloak of professionalism, are, as you say, Dave, they tend to sell more, they tend to get better customer satisfaction ratings. Customers tend to get the products and services that they need as opposed to those that are being pushed for. And financially, they create more value for the bank as well. So it's really interesting. And there are some things that can be done to help people in that space. Obviously, a lot of training and all the rest of it. But it's also about the provision of the right information about the customer in the context of the conversation. So you can use digital and technology to support the sales assistant to have that sensible, credible, trustworthy conversation. We had another question about what's the sort of time frame and cost to deliver the different 6 pillars, and is there any research about that shows the average amount of time it takes to see the desired outcome within the 6 pillars? It's quite a detailed question. I don't know whether that's something that Nunwood has really dug into and researched yet, or is that something that may be coming down the line in the future?
A little bit of both. So the early views are that organisations that are completely single-minded in their purpose, completely focused on achieving a difference for customers, can do so within a 9 to 12 month time frame. So if I use the example of Nationwide Building Society, who 6 years ago set out to fundamentally put clear blue water in their language between them and how their customers felt about them and their high street competitors, then it was an intense, almost, if you can use a basketball phrase, full court press. It was every aspect of their business was organised to move the relationship forward. And we saw an improvement of something like 23 points in a 12-month period on their customer satisfaction scores. However, if you are not so single-minded on it, then it can take 3 years or indeed 5 years. And some organisations have been on a 10-year journey. But the lack of understanding the systematic series or sequence of applying the 6 pillars means that organisations often sort of go off-piste a little bit. And so our research shows that there is almost a Maslowian hierarchy of needs at play here, which is the very first thing that you've got to attend to is any reputational issues. So on an NPS score between 0 and 10, what we see is that scores between 0 and 3 tend to be reputational, so you didn't do what you say you're going to do. Scores between 3 and 4 tend to be resolution, so it went wrong, you didn't fix it very well. Between 4 and 5, they're about you didn't set my expectations properly, so when you delivered, I wasn't expecting what you did was consistent with my expectations. And then if we look at time and effort, well, time and effort gets you sort of 5, 6 or 7. You can do wonderful things by taking barriers away for customers. But the 2 that make a difference, the 2 that fundamentally drive a 9 or a 10 on an NPS scale is personalisation and empathy, the human factors that make the difference. So our research says if you focus on removing the causes of detraction, whilst at the same time focusing on the drivers of promotion, and actually moving both of those things together, you get a compound effect. And that's what we've seen with Nationwide, it's what we've seen with Santander, it's what we see around the world with organisations that make seminal movements in this particular space and do so in a reasonably short period of time. But I would say that you are talking, for most organisations to see substantive impact from what they're doing, we're talking a 1 to 3 year time frame.
Great. You have, by coincidence, answered a couple of other questions, which is fantastic. I'm conscious of time, so there are a number of other questions that we haven't had time to really nail within the hour. So I think what we'll do is we'll respond to those to the individuals by email. So thank you very much for asking those questions. And as I say, we'll get back to you. Hopefully some of the questions that we haven't directly answered, Dave has literally just nailed in the last sort of 30 seconds or so. But thank you very much for joining us, and hope that's been useful, and look forward to you joining us on future webinars as well.
Thanks very much. Thanks, Mark.
Have a good day. Bye now.